Let me tell you about something that keeps me up at night. This isn't some theoretical scenario anymore. It's not a fringe economic prediction about the future. It's happening right now. And most people don't realize just how close we are to a financial crisis that could fundamentally transform the global economy. The United States national debt recently surpassed $36.2 trillion. That figure is so enormous, it becomes almost incomprehensible for ordinary people. But here's what makes it real and concerning. Just the interest payments on that debt reached $881 billion last year. That exceeds what we spend on Medicare. It's more than our national defense budget. We're shelling out nearly $1 trillion annually just to service existing debt, and projections show that number climbing to $952 billion this year. You might think the US has always carried debt. So what's different now? And you'd be correct about the historical precedent. But what distinguishes this moment, what makes it fundamentally unprecedented, is that the entities who have been purchasing that debt, the ones who have financed American spending for generations, are abandoning ship. Not gradually, not carefully. They're fleeing. Consider some figures that should alarm anyone who grasps how global finance operates. China possessed over $1 trillion in U.S. Treasury bonds just a few years back. By December 2024, that had fallen to $759 billion. That represents 9 straight months of reductions. It's the lowest point since 2009, right after the financial crisis hit. In just the first quarter of 2024, China offloaded $53, $3 billion in US bonds. That's not simple portfolio adjustment. That's a deliberate withdrawal. But China isn't acting alone. Japan, actually the biggest foreign holder of US debt at $1.06 trillion, just sold $119.3 billion in a single quarter. That's the sharpest decline since 2012. And here's what really grabbed my attention. In just a 2 week period in April this year, Japan sold over $20 billion. The United Kingdom, another significant holder, dumped $44.1 billion in December alone. When you combine China, Japan, and the UK, that's $81 billion sold in 1 month. These aren't random market movements. These are coordinated strategic choices by the world's major economies to minimize their exposure to US debt. And we need to grasp why this is occurring because the underlying reasons reveal where this is heading. First, there's the geopolitical factor. After Treasury Secretary Janet Yellen publicly raised the possibility of seizing Russian dollar assets following the Ukraine invasion, something fundamentally changed in Beijing. Chinese leaders recognized that if America could weaponize the dollar against Russia, it could do the same to China. So how did they respond? They accelerated their treasury sales and began accumulating gold. Chinese gold reserves grew to 2,235 tons by the end of 2023. They're not merely diversifying, they're constructing an alternative system. Second, there's the de-dollarization trend that's been building momentum. The dollar's proportion of global foreign exchange reserves has dropped to just under 60%. That might not seem dramatic, but think about this. In the early 2000s, it stood at 70%. By the first quarter of 2025, it had declined to 57.7%. That's a 2 decade low. The world is actively seeking dollar alternatives, and each percentage point that falls makes US debt less appealing. Third, and this is crucial, there is the trade war instability. During the tariff escalations in April 2025, we witnessed the 10-year Treasury yield jump from under 4% to 4.5% within days. The 30-year yield exceeded 5%. That level of volatility is toxic for foreign central banks that require stable, predictable returns. If owning US debt means experiencing wild swings every time there's a political conflict, why would you continue holding it? Now, here's where this becomes genuinely alarming. The US Treasury needs to borrow over $10 trillion this year alone. That's more than a third of all outstanding US debt. For just the first quarter of 2025, the Treasury anticipates borrowing $823 billion in privately held net marketable debt. That's not discretionary spending. That's money required simply to keep government operating and to refinance maturing obligations. So what occurs when you need to borrow $10 trillion and your largest buyers are selling? Basic economics dictates the price must adjust. In bond markets, that means yields must increase. Higher yields mean higher interest expenses. Higher interest expenses mean more borrowing. More borrowing means more debt requiring buyers. It's a self-reinforcing downward spiral, and we're already caught in it. Let me describe what this looks like in practical terms. The Congressional Budget Office forecasts that interest payments on the debt will total $13.8 trillion over the coming decade. That's growing from $952 billion this year to $1.8 trillion by 2035. By 2035, we'll be dedicating 4.1% of GDP purely to interest payments. That will be the highest proportion since 1940 during World War II. But here's the catch. Those forecasts assume relatively stable interest rates. They assume buyers will exist for U.S. debt at reasonable prices. What if those assumptions prove wrong? What if foreign buyers keep retreating and the Fed can't intervene because it's battling inflation? We got a glimpse of this in March 2020 during the pandemic crisis. Treasury market liquidity deteriorated so drastically that the Federal Reserve had to purchase $360 billion in treasuries in a single week just to maintain market function. The market essentially seized up. If the Fed hadn't stepped in, the US government would have confronted a funding crisis in the middle of a pandemic. Some will argue that domestic buyers are filling the gap. Individual investors through mutual funds have assumed a much larger role. Hedge funds represented through Cayman Islands entities actually became the biggest purchasers between June 2024 and June 2025. That's accurate. But here's the problem. Domestic buyers are unreliable, they're sensitive to price, they'll demand higher yields if they sense increased risk. And unlike foreign central banks that often purchase treasuries for strategic purposes regardless of yield, domestic buyers are purely motivated by profit. Banks, which were once major holders, have actually reduced their treasury holdings by $154 billion year over year. They're not interested at current yields, not when superior returns are available elsewhere. So we're increasingly dependent on the most opportunistic buyers in the market, the ones who will vanish at the first hint of trouble. The Federal Reserve finds itself in an impossible situation. They've been conducting quantitative tightening, allowing $60 billion monthly in treasuries to roll off their balance sheet. They recently reduced that to $5 billion monthly as of March 2025 because even they recognize the market can't absorb the selling pressure. But here's their dilemma. If they halt quantitative tightening entirely, or worse, restart quantitative easing to purchase treasuries, they risk reigniting inflation. If they don't act, they risk a treasury market crisis. There's no good choice. Let's examine what happens in the worst case scenario where foreign buying doesn't just slow down but actually stops completely. Here's the cascade. First, within days, you'd see treasury auctions begin to fail or require dramatically higher yields to clear. The government would have to offer perhaps 6, 7, maybe 8% on 10-year bonds to attract buyers. Every percentage point increase in borrowing costs adds hundreds of billions to the annual deficit. Second, mortgage rates would surge. The 30-year mortgage rate is linked to the 10-year treasury yield. If that reaches 7 or 8%, the housing market freezes. Home sales collapse. Construction halts. That's millions of jobs and a major economic sector in free fall. Third, corporate borrowing costs explode. Companies needing to refinance debt or raise capital for expansion suddenly face double-digit interest rates. Investment stops, hiring freezes, layoffs begin. The stock market, which is already overvalued by historical standards, would collapse as both earnings expectations and valuation multiples compress simultaneously. Fourth, the dollar weakens. This seems counterintuitive, right? Normally, when treasury yields rise, the dollar strengthens because foreign investors need dollars to buy those high-yielding bonds. But if the selling stems from lost confidence in U.S. fiscal sustainability, the dynamic reverses. We observed this in April 2025 when the dollar weakened while treasury rates rose. That's a toxic combination, and it's precisely what happened to the British pound during the Liz Truss crisis in 2022. A weaker dollar means imported goods become costlier. That's inflation. So now you have higher borrowing costs and accelerating inflation simultaneously. That's stagflation. And it's the nightmare scenario for which the Fed has no effective tools. Raise rates to combat inflation, and you worsen the debt crisis. Cut rates to ease the debt burden, and you worsen inflation. Fifth, the government confronts impossible choices. With interest costs consuming an ever larger budget share and borrowing costs skyrocketing, something must give. Do you cut Social Security, Medicare, defense, infrastructure? There are no popular options. Political paralysis sets in precisely when you need decisive action most. Some economists will insist this is all exaggerated. They'll note that the US has the deepest, most liquid capital markets in the world, that the dollar remains the global reserve currency, that US Treasury bonds are still regarded as the safest asset on earth. They'll argue that even with all the selling, there's still enormous demand. And they're right to a point. The Treasury market is massive, roughly $26 trillion in publicly held debt. Daily trading volume is enormous. It would take a great deal to truly break this market. But here's what they're overlooking. Confidence is binary. It exists until it doesn't. Markets can function normally for years with slowly deteriorating fundamentals and then collapse in days when sentiment shifts. We've witnessed this pattern repeatedly throughout history. It happened to Greece, it happened to Argentina, it happened to the UK in the 1970 seconds. The British pound sterling served as the world's reserve currency for centuries until it didn't. These transitions don't occur gradually. They happen suddenly when the market recognizes that the math simply no longer works. And let me be clear about the math. It doesn't work. The Government Accountability Office just released projections showing that U.S. debt will reach 200% of GDP by 2047. That's 3 years earlier than they projected just a year ago. We're at 99.8% right now. The fiscal year 2025 deficit was $1.8 trillion. We are adding to the debt faster than the economy is growing. That's unsustainable by definition. Now, there's a school of thought, modern monetary theory, that claims this doesn't matter, that a country borrowing in its own currency can never go bankrupt because it can always print more money. And technically, that's accurate. The US cannot be forced into default the way Greece was because we control our own currency. But that doesn't mean there are no consequences. The consequence is inflation. The consequence is a collapsing currency. The consequence is a dramatic decline in living standards. Here's something most people don't grasp. The US benefits enormously from dollar hegemony because the dollar is the global reserve currency. There's structural demand for dollars and dollar denominated assets that allows the US to borrow at much lower rates than would otherwise be possible. One study estimated that losing reserve currency status would reduce sustainable debt levels by about 22%. If we're at 100% of GDP now, losing that status would mean the sustainable level is around 78%. We'd need to reduce debt by approximately $7 trillion just to return to sustainable levels. That's not happening. Instead, we're moving in the opposite direction. Every year, we're adding more than $1 trillion to the debt. The structural deficit, the gap between revenue and spending, runs about $2 trillion annually and growing. Even if we experienced perfect economic growth and never had another recession, we'd still be adding unsustainable amounts of debt every single year. The political system has completely failed to address this. Both parties bear responsibility. Republicans cut taxes without cutting spending. Democrats increase spending without raising sufficient taxes to pay for it. The result is that deficits explode regardless of who controls government. And now we've reached the point where politics makes a solution virtually impossible. Think about what would be required to actually stabilize the debt to GDP ratio. You'd need some combination of significant tax increases and spending cuts totaling somewhere around $2 trillion annually. That's roughly 10% of GDP. The economic contraction from implementing that would be catastrophic. We're talking Great Depression levels of unemployment. So no politician will do it. They'll kick the can down the road until crisis forces their hand. But here's the cruel irony. The longer we wait, the worse the eventual adjustment becomes. If we'd addressed this 10 years ago, we could have made gradual changes that spread the pain over time. Now we're so far into the danger zone that any solution will be painful, and the likelihood of a market-imposed solution, which would be far more painful than a policy-imposed solution, increases every day. I want to be clear about what a market-imposed solution looks like, because I think people imagine it as some abstract financial event. It's not. It's real, tangible consequences for real people. Interest rates spike, your adjustable rate mortgage payment doubles. Your credit card interest rate goes to 25 or 30%. You can't refinance your car loan. Your employer can't make payroll because they can't access credit. Your retirement account loses half its value in months. The government, facing a funding crisis, makes emergency cuts. Social Security checks are delayed. Medicare payments to providers are reduced and hospitals start closing. Federal employees are furloughed. Government contractors aren't paid. The ripple effects cascade through the economy. Unemployment spikes to 15, maybe 20%. This isn't fear mongering. This is what happens when a major economy faces a debt crisis. We've seen it before in other countries. Now, there are potential paths that don't involve catastrophe, but they all require things that seem politically impossible right now. One option is sustained high economic growth that outpaces debt growth. If we could achieve real GDP growth of 4 or 5% for a decade, we could grow our way out of this. But that would require massive deregulation, tax reform, immigration reform to expand the workforce, infrastructure investment, education reform. It would require both parties working together on a comprehensive growth agenda. Does anyone believe that's happening? Another option is significant inflation that erodes the real value of the debt. If we had, say, 6 or 7% inflation for a decade, the debt to GDP ratio would improve dramatically because GDP would be rising in nominal terms faster than the debt. But that's essentially a hidden default. It destroys savings, hurts retirees, creates social instability, and once inflation gets embedded in expectations, it's incredibly difficult to bring back down without causing a severe recession. A third option is financial repression, where the government forces domestic institutions to buy treasury bonds at below market rates. This was done after World War II. Banks, insurance companies, pension funds were essentially required to hold treasuries yielding less than inflation. It worked to reduce the debt burden, but it also meant savers earned negative real returns for decades. Good luck selling that to the American public. The most realistic scenario, unfortunately, is probably some combination of all the above, implemented chaotically during a crisis rather than planned carefully in advance. We'll get a market shock that forces action, yields will spike. The government will respond with some mix of spending cuts, tax increases, financial repression, and probably some Fed intervention that borders on debt monetization. It will be messy, painful, and the economic contraction will be severe. What really worries me is the geopolitical dimension. America's power in the world is built on economic strength and the dollar's reserve currency status. If we go through a debt crisis that undermines both what happens to the international order, China is watching this carefully. They're building alternative payment systems, internationalizing the yuan, creating institutions like the Asian Infrastructure Investment Bank to compete with the IMF and World Bank. If the dollar collapses, China becomes the dominant economic power by default. Think about what that means. The Chinese Communist Party, not exactly known for its commitment to human rights and democracy, becomes the center of the global financial system. Countries around the world have to align their policies with Beijing's preferences rather than Washington's. The post-World War II international order, which for all its flaws has prevented great power conflict and spread prosperity to billions, that order collapses. We could be looking at a far more dangerous authoritarian world. So what should people do? What's the practical advice for someone who understands this is coming but can't single-handedly fix U.S. fiscal policy? First, reduce your personal debt exposure, especially variable rate debt. If interest rates spike, you don't want to be caught with an adjustable rate mortgage or a home equity line of credit that suddenly doubles your monthly payment. Second, diversify your assets internationally. Don't keep everything in dollar-denominated assets. Own some foreign stocks, some property outside the U.S. if you can afford it, maybe some gold. I'm not a gold enthusiast, but gold does tend to hold value when fiat currencies are in crisis. Third, invest in skills and education that are portable. If the US goes through a prolonged period of economic stagnation, you want to be able to create value in any environment. Technical skills, professional certifications, language abilities, these things retain value even when financial assets are volatile. Fourth, build resilient communities. In a crisis, your network matters more than your net worth. Strong relationships with family, friends, neighbors, professional contacts, these are the things that help people weather storms. I know this all sounds grim, and I want to be clear, I'm not predicting the end of the world. Uh, the US economy remains the most dynamic, innovative, productive economy in human history. American companies dominate global technology, finance, entertainment, agriculture. We have incredible universities, incredible infrastructure despite the deterioration, an incredible legal system that protects property rights and enforces contracts. These are real strengths that give us enormous resilience. But we are living through a turning point. The post World War II era of unchallenged American economic dominance is ending. The dollar's reserve currency status is eroding. Our ability to borrow unlimited amounts at low interest rates is disappearing. The question is whether we manage this transition competently or whether we stumble into a crisis that forces a much more painful adjustment. My fear is that our political system is too broken, too short term focused, too captured by special interests to make the necessary changes voluntarily. And that means we're likely to end up with the crisis driven adjustment, which is always more costly than it needs to be. The debt crisis isn't approaching, it's here. Foreign buyers are already walking away, interest costs are already spiraling, the fiscal math already doesn't work. We're just in the phase where most people haven't realized it yet because the consequences haven't fully materialized. But they will. The laws of economics haven't been suspended. You can't borrow forever without consequences. And when those consequences arrive, they tend to arrive faster than anyone expects. What we're experiencing right now is the slow motion unraveling of the financial architecture that supported American prosperity for 80 years. Future historians will look back at this period and wonder why we didn't act sooner, why we didn't make the hard choices when we still had time. But that's always how these things appear in retrospect. In the moment, there are always reasons to wait, always arguments that this time is different, always political incentives to kick the can down the road one more time, except we're running out of road and the cliff is getting closer.